Buddy, hope you're having a great weekend. We are ready or getting ready for another great week in the market. Just going to briefly touch over some of my thoughts and things that I look at. For starters, the last time I shared the Wall Street Journal front page of the market section, everything was gloom and doom, recession, market crash coming, and we just finished a nice little rally over the last 3 days or so, and now look at it. Falling food prices erase pressure of global inflation. Investors love tech stocks. The power of positive thinking. Crypto prices crash, but true believers are holding on. It just all of a sudden started turning positive, where the narrative is no longer gloom and doom, but it's looking positive. So if you recall the video I made the last time I posted this, I said it's a trap. It's a bear trap. They're trying to get people to sell. They're trying to get people to go short so they can have a little rally. It's happening again. Opposite direction. They're trying to get you excited. They're trying to get you to buy in my opinion, for another slide. And we started the year up here at a record high, record levels, and just continue to go down slowly, continue to go down. And then we made a new low, and then we had a real rally that failed, and we made a new low. End of July, we had this little rally, and here we are in August with a peak. Problem with this chart is it's dated 2008, and what happened the rest of 2008 was further and further declines. Is that what's going to happen this year? Do I think that we're gonna crash down 50% off of the top? Well, not necessarily, but I speak a lot of history, and history tells us that if we look at midterm election years, and this is based on the last 29 years, and this is just midterm election years, X'd out all the other years, you have July has a rally that fails, August has a rally that fails, September has a rally that fails, and at the end of September, middle of October, beginning of October, you have the low of the year. That is the lowest point of the year on all midterm election years, and this is a midterm election year. And then you end up with the rally at the end of the year. That's just what history tells us. Is that what's happening again this year? Do I think that same thing is going to happen again this year? Well, we have to have some kind of catalyst to continue to bring the market down, and the only catalyst that I can think of right now is the entire worry of recession, the worry of the market slowing down. So let's look at some of those indicators for a second. If we look at one of the few things that, well, this is one of the things that I keep talking about. When you talk about real earnings, the amount of money that, the amount of spending power that the money that you are bringing in has, not the amount of wages. Wages are going up, but when you compound inflation, when you put inflation into effect, look at this. 1983, 1982 was the last time that we had this little buying power. We have less buying power now than we have over the last 30 years. Every dollar can get you less now, and a lot of it does have to do with government spending and our inability to control our budgets. They just continue to weaken the dollar. But real wages has been in decline since 2020. Real wages has been in decline since 2020. Eventually this is going to hit a wall, and it's not going to look pretty. Real domestic products. So you heard a lot about GDP. GDP does not look as bad as GDI. Real gross domestic product is in decline, but then you have GDI that's also negative. And when you have those in complete decline, then you have, right now you have 4 of the 5 major categories showing that we are slowing down. It's kind of like, this famous person said? We're not in a recession. We're in a transition in which growth is slowing. She's absolutely right. Growth is slowing. Income is slowing. Production is slowing. The only thing that's not slowing is jobs. People are still being hired, but that's in every recession. That is the last category to go down. Let's talk about the SPY here for a second, because I know that that's one of the things that we most look at to be able to make a predictor, or not a predictor. You have to remember, as a trader, you have to be looking at price action. It's always price action first. If you're an investor, it doesn't matter. Go ahead and buy. This is a great time to buy if you're an investor. If you're a trader, especially if you're a swing trader, you need to be careful with your trades right now. What I want you to look at is the high of Friday was 413.03, 413.03. If you take this structure right here, which is the structure that I said we needed to break, the average of this structure is 413.05. Is it a coincidence that we stopped right there? I don't think so. This is the structure right here that we need to break through. If we don't break through this structure, then the likelihood of us continuing down are very, very high. Can we break through this structure? I think so, but I kept saying that what we needed to do was create some kind of a pattern where we go back down to test a previous structure, which would be this structure here. If we go down to test this structure, test it for strength and bounce off of it, I will feel much more comfortable than if we just continue to move up here. That structure currently sits at 400. On Friday we got to 406 and came back. I was expecting and I want it to come back and test 400. But if we come back down and test and we break this structure, the 400, this structure is next right here at 390. And if 390 is broken, well, it's gonna get a little sketchy. One of the things I look at is when we made this most recent move, we left the gap there. We still have a gap here, and I think the statistic is 95% of gaps need to get filled. Leading market stocks like Apple, look at that gap. Look at the size of that gap right there. That is a big gap. Gap right there. Will this one get filled? I don't know that this one will get filled. This one, I sure hope this one right here gets filled. Tesla left a gap. Apple left a gap. Microsoft left a gap. Google left a gap. Amazon left a gap. Many of these stocks left a gap, and these stocks are stocks that I expect to lead the market. When we look at things like the McClellan oscillator, it's a good indicator of the turns in the market. You could see that currently we're sitting at 50.49 on the McClellan oscillator. The last time that we were at 50.49 was at the end of May, right here on this structure. We were over 50, and when we got over 50, this is what followed. The time before that, when we were at 50, was in March, right here, and look what happened afterwards. The McClellan oscillator is a good indicator. The Russell, when it gets over 50, comes down. Right now, it's at 90. Look at this. The Dow, here we are. Every time it gets to this level right here, it comes down. Right here, comes down. The Nasdaq. Every time it gets to these elevated levels on the McClellan oscillator, what follows is a downturn. This is what would we consider an overbought environment, where people felt like they were missing out and they started buying. A lot of shorts got squeezed, and I think that was part of the game, was to try to squeeze out as many shorts as possible, and a lot of them got caught. Now, another indicator to me of whether we're overbought and oversold is the percentage of stocks over the 50-day moving average. Right now, we're at 12% right here. This is where we're at. This is where we closed on Friday. The last time this many stocks were over the 50-day moving average, December of 2020. Look at that. December of 2020. That means that all of 2021, we didn't have this many stocks over the 50-day moving average. We just had this massive jumps in amount of stocks that moved over the 50-day moving average. And it has to even out. The baseline is down here. This is your baseline. This is where we belong. So if we're not on the baseline, you have to expect some kind of retracement. And if you're continuing to buy into this rally is going to fail. It doesn't have to fail all the way down to new lows, but it does have to retrace a little bit to get some of these overbought indicators off of this beaming. They're just flashing, quit buying me. They're flashing, they're saying don't buy me so much. We are at the structure that I was looking for. I want to break this structure. I want to be bullish and continue up, but there's too many bear signals that are telling me that we need to have a pullback. So I hope you don't get caught in this frenzy. I will tell you that almost everything I bought last week, I sold last week. I sold everything that I bought last week other than my long-term holdings. I didn't carry anything over the weekend. If I miss a move from here to 420, that's okay. I don't mind missing a move from 413 to 420. I don't want to get caught in a move from 413 to 400. I think the move from 413, 415 to 400 is going to be a lot faster than the move from 413 to 420. So I'll catch the price action when I see the price action going on Monday. If the price action is down, I will play the downside. If the price action is up, I will play the upside. But my position sizing playing the upside will be very small this week, because I am expecting at some point to have some kind of retracement, and I really don't want it to be the 2008 retracement, which ends up at a lower low of year at the end of September, beginning of October, which is the trend on midterm election years that we're in right now. Be careful out there. Don't get greedy. Take profits when you have it. And if you have any questions, any advice for anybody, by all means, HaiKhuu is the place to share your thoughts and have opinions from professionals that do this all the time, that do this for a living. We'll tell you how we feel about it. I'm very honest with my thoughts and my sentiment towards the market. In my heart, I am a bull, but I do believe that we need to cool off in order to continue up. Have a great weekend. We will see you on the Discord.